Hello and welcome to Business Incorporated. I'm Bisi Adebayo. Coming up on the program today, Zimbabwe's annual inflation drops to 659.4% in September. Uganda's central bank says no license needed for foreign lending in the country. And Ethiopian government puts partial privatization of Ethiopian Airlines on hold. Well, let's begin the program right away, and we're starting with the intraday numbers coming from Africa, which were all in positive territory. In South Africa, the JSE saw the highest gain of 0.43%, while Nigeria's main index rose 0.11%. Egypt's EGX30 advanced 0.4%, and Kenya closed negative on Tuesday. Well, it's a different picture in the Middle East, and investor sentiments were mostly negative at intraday, except for Abu Dhabi, where the index was up 0.61%. On the flip side, though, Dubai's main index shaved off 0.86%. Elsewhere in the region, the Qatari index declined 0.31%, while Saudi Arabia's index lost 0.06%, also at intraday. And crossover now to Europe, where stocks are mostly higher as coronavirus concerns weighed on global markets. But let's talk to Chelsea Delany to tell us what's driving the markets at this time. Good afternoon, Chelsea. So Eli Lilly became the latest drug company to halt trials for coronavirus drugs amid safety concerns. How are investors taking this news?
It's been a bit of a disappointment for investors. There's no doubt about that. We have seen over the past 2 days, as these announcements have been made, stocks really seeing a lot of volatility based on the delays. It's not unusual for drug makers to have to halt trials. Johnson & Johnson, for example, which is one of the front runners in the race for a corona vaccine, has about 60,000 people enrolled in these trials. So the odds of one person getting sick is quite high, but it's still very concerning for the markets and for global investors, because there's so much expectation now that we will find a coronavirus vaccine quite soon. Many investors had hoped that we would see a vaccine approved in the coming months, really by the end of the year, and instead what we've seen is a number of the front runners in the development of a vaccine, from Johnson & Johnson to AstraZeneca, having to halt their trials because of unexplained illnesses. This will likely push the timeline back for a vaccine, especially one that will be widely available, because all of these drug makers need to work together to really produce enough for the entire world. So that means that the recovery in the global economy, really the normality that people are hoping for, also gets pushed down the road a little bit too. So investors still watching these developments very closely, but the hopes that we would see a vaccine approved in the coming weeks, in the coming months, it looks more and more like that won't be happening.
All right. Now, EU countries have agreed on a common traffic light system of coronavirus travel restrictions. What has the response been from the travel industry?
This system is less than a day old now, and it's already been heavily criticized by the travel industry. What we had seen before in Europe is that every country was assessing risk areas in a different way, and they all had different rules for travelers from different countries. So it was very chaotic and very confusing. So the EU was trying to harmonize these rules. What they've come up with is this traffic light system that we've seen in other countries. You have green for low risk, orange for medium risk, and red for high risk. So the EU countries have agreed to all recognize this map system, the traffic light system. But what they haven't done is agreed to harmonize rules about what the risk will mean. So every country still has the right and will be able to set restriction rules, quarantine rules, other travel restrictions by themselves. So there really still are a lot of potential for differing rules among EU countries. For the travel industry, this is a disappointment. We've heard from IATA, one of the major travel industry, airline industry groups, that this is a political failure and it has disastrous consequences for the airline industry, which had been hoping that travel would pick up again once these new rules were introduced. This is really dashed hopes because the requirement to quarantine, the restrictions are still likely to be in place across Europe for the foreseeable future.
Meanwhile, Chelsea, the EU is saying that it hopes to avoid a renewed trade fight with the U.S. after the World Trade Organization gave the bloc power to levy penalties on $4 billion of U.S. goods. Can the tariffs be avoided?
The outcome is really going to depend on what happens in the U.S. November election. So the EU does have the right to impose these tariffs now. They say they want to wait and try and seek some sort of negotiation with the United States, but the outcome of the election will clearly determine the trade strategy of the United States. The EU and the U.S. have been having talks about these tariffs for several months now, but they really haven't gotten anywhere. The EU wants all tariffs related to these aircraft subsidies to be removed because the U.S. has also put tariffs on EU goods over this as well. So they want basically the slate wiped clean of tariffs. The U.S. has been reluctant to do that. But obviously, if there's a new president in the White House in the months ahead, that could open the door for other negotiations. And we've heard from Joe Biden and some of his campaign members that they likely would be more willing to negotiate with the EU and that they really want to bring the EU on as an ally. So it's obviously going to depend on how the election outcome is to see how the future is for these tariffs.
Thank you, Chelsea. Enjoy the rest of your day. Well, let's take a trip to the UK now, where Juliana Olayinka will be telling us what headlines are driving the markets at Intraday. Good afternoon, Juliana. Well, let's begin our conversation with this report coming from the Organization for Economic Cooperation and Development, that's the OECD, saying that the coronavirus pandemic risk worsening child poverty and inequality in the UK. Now, the think tank is also warning that another major negative impact will be on trade and jobs, and that could come from a no-deal Brexit. Could you tell us more about this report?
Well, yes, the OECD say that Britain is at a critical juncture when it comes to the economy. Obviously, that headline is no news to Britain. They've been facing it through a series of different issues. Not only are we dealing with COVID, but as you quite rightly said, Brexit is a major issue. And of course, the OECD is a Paris-based think tank. So they've got a lot of inside information of what's happening on the continent. Really, this is to do with tomorrow. Tomorrow, of course, was the Prime Minister's self-imposed deadline to get a Brexit deal with the EU. That is definitely going to come and go. Downing Street are already giving out fillers saying that they're likely to try and push for a deal by the 1st of November. But the fact that Britain is the worst G7 nation to have coped with COVID-19 hasn't really helped, especially because we do have Brexit. So they have been outlining a series of forecasts for the British economy. I spoke this morning with Chimaze because yesterday the International Monetary Fund also looked at how Britain's economy will fare, not just in 2020 and 2021. They believe that our economy will contract by about 9%. The OECD actually went further and said it will contract by more than 10%. And they also feel that next year, the recovery in 2021 will be a lot slower. Now, this is the first time that the OECD has actually looked specifically at the British economy. They always look across the globe, but they haven't looked at the British economy for about 3 years. Their suggestions and the report has been welcomed by Downing Street. They're interested in everything that the OECD has to say. But it's interesting, they did strike the same balance with the IMF in saying that Britain shouldn't be too quick to pull away some of the subsidies that they're using to help individuals. If individuals do not have money in their back pocket, they cannot top up the economy. So they do advise that some of these furlough schemes, which we know will be coming to an end at the end of this month, do keep going on along the lines of what we've seen in places like Germany and France.
All right, Juliana, I guess it's not all gloom and doom for everyone during this pandemic, and that's talking about online fashion group Asus, which says it now has 23.4 million customers with more than 7 million in the UK, where it makes the bulk of its profits. Of course, it's pretty obvious that that group is one of the winners at this time, isn't it?
You would think so, and of course, those numbers are definitely impressive. The fact that their sales have surged by about over 300% during the pandemic, you would think that that was good, but that's just the headline. As soon as they released their trading update this morning, their shares fell 7%, and that's really because of the season that we're going into. Asos, or As Seen on Screen, as it was called previously, they are part of fast fashion, online fashion, where it's cheap and it's cheerful. You get your clothes the next day. But their main customer base is those 20-somethings, and they have 7 million customers here in the UK. Now that we're having new restrictions, now that Christmas is essentially cancelled, there are no Christmas glitter dress shopping. People are not shopping in those sectors. What people are usually shopping at in Asos, according to their trading report, is loungewear and sportswear, which is quite cheaper. And so there are concerns, there are worries that, yes, they've had a great few months during the pandemic, but what about the next seasons, particularly as yesterday's job data, which showed that unemployment had risen to 4.5% in the UK. The overwhelming majority of the 1.5 million people in this country that are unemployed are those 16 to 24-year-old age gap. And those are the people that buy from Asos. And unfortunately, it doesn't look like they'll be spending that much money on the site in the next coming months.
So we'll be waiting to see what the numbers will look like in the future. But meantime, Juliana, tell us, what are the intraday numbers looking like at the moment?
Well, at the moment, the FTSE is very much in the red. The all share is unchanged at intraday. The FTSE 100 is down 0.03%. The FTSE 250 is up slightly at 0.40%. In currencies, the British pound is up on the US dollar by 0.15%, up on the euro by 0.22%, and up on the Japanese yen by 0.10%. At intraday, all of the sentiment is coming from Brussels and the fact that Boris Johnson has once again set a deadline and is likely to miss it tomorrow.
Thank you, Juliana. We'll see you again tomorrow. All right, moving on now to Asia, where stocks were lower today as investors reacted to a speech from Chinese President Xi Jinping. Mainland China's stocks were lower, with the Shanghai Composite down 0.56% to about 3,340.78, while the Shenzhen Component declined 0.779% to around 13,691.04. The Hang Seng Index in Hong Kong closed fractionally higher at 24,667.09. In Japan, the Nikkei 225 bucked the overall trend among the region's major markets, rising 0.1%, and the Topix Index shed 0.32%, ending its trading day at 1,643.9. In South Korea, the Kospi declined 0.94%, and shares in Australia were also lower, with the S&P ASX 200 slipping 0.27%. And in the U.S. stocks index, futures rose in early morning trading after the major averages registered their first day of losses in 5 trading sessions. Futures contracts tied the Dow Jones Industrial Average, advanced 100 points. S&P 500 futures and Nasdaq 100 futures also traded in positive territory. Stocks fell on Tuesday, snapping a 4-day winning streak. The Dow Jones Industrial Average slid 157.71 points, while the S&P 500 declined 0.6%, and the Nasdaq Composite was the relative outer performer, dipping 0.1%. We're staying with the markets, but this time and the commodities segment, and we're talking oil prices now. They actually slipped in early trade today on concerns that fuel demand will continue to falter as rising coronavirus cases across Europe and the United States, the world's biggest oil consumer, could impede economic growth. Brent crude futures for December fell 0.3% at $42.33 a barrel, while US WTI futures were down 0.3% to $40.09 a barrel. The Organization of the Petroleum Exporting Countries said in its monthly report on Tuesday that oil demand in 2021 will rise by 6.54 million barrels per day to 96.84 million barrels per day, and that's as a result of the economic dislocations caused by the coronavirus pandemic. We'll be talking about foreign lending in Uganda when we return in just a moment. Please stay with us. Welcome back. Data from the Zimbabwe National Statistics Agency shows that year-on-year inflation fell to 659.4% in September 2020 from 761% recorded in August. On a month-on-month basis, consumer price index declined to 3.83% in the month under review from 8.44% the previous month. Over the past few months, the government has been implementing a cocktail of measures premised at containing the inflation that had eroded incomes of many Zimbabweans. One of such measures was the Reserve Bank of Zimbabwe ordering the closure of mobile money payment platforms, including EcoCash and One Money agent lines, which had been accused of fueling illegal foreign currency dealing. And in Uganda, the central bank has said that foreign-based banks do not need its license to lend funds originating abroad, reassuring an industry jolted by a court ruling last week that declared some syndicated loans involving foreign banks illegal. The loans affected by the commercial court ruling represent at least $1.5 billion worth of debt. The Bank of Uganda says it did not regulate lending that involved using funds obtained from foreign banks that do not take deposits from the Republic in Uganda. The bank says it's not mandatory for a foreign bank to establish a representative office in Uganda in order to conduct lending, as foreign banks lending deposits held in jurisdictions other than Uganda are regulated and supervised by their home authorities. Let's head now to Ethiopia, where the Ministry of Finance has announced a temporary suspension of the planned partial privatization of Africa's biggest aviation and leading company, Ethiopian Airlines. The move comes on the heels of the same measures taken recently to roll back the planned privatization of Ethiopian shipping and logistics service enterprise. The minister explains that the plan is put on hold as the company continues to be profitable and competitive in the global aviation industry. Meanwhile, the ministry forecasts the Ethiopian economy to register 8.5% growth in the 2013 or 2023 budget year. South Africans are waiting eagerly to hear what's on President Cyril Ramaphosa's economic recovery plan, which he is expected to unveil on Thursday. The country's economic recovery was central at the ruling African National Congress National Executive Committee and again at the Presidential Economic Advisory Council. It said that the 48-page draft titled South African Economic Reconstruction and Recovery Plan will outline 8 priority areas to rebuild and grow the economy. We spoke to an economist, Bukani Mungoma, on what should be at the base of that plan, and here's what he had to say.
Given the fact that South Africa had a very hard lockdown, and the reason for a hard lockdown was that we got into the lockdown just on the eve of winter. So the government had to basically implement the lockdown. What that means is that the devastation the lockdown has done in our economy, comparatively speaking to other African countries, it's far worse. So when you talk about a recovery plan, what I expect from the president is that, one, he needs to be able to then say to us, he must acknowledge first the devastation that has been caused by the hard lockdown. But he needs to be able to say to us, well, in 2018 and 2019, respectively, there were 2 international investment summits in South Africa. Obviously, in those summits, investors committed themselves. Billions of rands were committed into the economy of the country. Now, we need to find out as to how are we in terms of those investments. Obviously, some of them have disappeared, given the fact that COVID-19 has affected everybody. But at least it needs to be able to say to us, these are the areas or investment projects which were promised and will be continued, because we need infrastructure-led recovery. So if we do not invest in the infrastructure, it will then be very difficult for us to be able to recover this economy. So as much as issues like the security of electricity, like Eskom in particular, it's important. But from an investment point of view, there needs to be a lot done in investing in the infrastructure, because the benefit with investing in the infrastructure is that it has a multiplier effect of creating mass employment. Remember, during the lockdown, we lost about 2.5 million workers in our economy. So we need those workers back into the economy if recovery has to be sustained.
South African economist Buchanan Bungoma. Well, staying in South Africa now, as the government begins to reopen the economy, the government says that attracting foreign investments is a major part of the recovery strategy. But with an economy already in recession even before the COVID-19 pandemic, analysts believe a lot has to be done to boost investor confidence.
Africa's economy contracted by 51.1% in the second quarter of 2020, its largest shrinkage dragged down by the effect of the COVID-19 pandemic. The country was already in recession by the time the country went into a strict lockdown earlier this year. And in 2019, the country dropped to 84th out of 190 economies, slipping 2 places on the World Bank's influential Ease of Doing Business report. As the country opens up, how ready is it to attract international investments?
Comparative to the rest of the African continent, we're significantly ahead in terms of infrastructure and institutional integrity and strength, taking into account institutions such as the SAP, taking into account institutions that such as the FSCA and the levels at which they operate. So that all bodes well for South Africa from an investment perspective.
South Africa is no longer as attractive as it used to be, but more importantly also, both domestic investors as well as consumers do not have any confidence in the economic outlook of South Africa. And therefore, with the COVID-19 crisis, that probably has worsened.
Apart from the COVID-19, there are other elements like corruption, a weakening rand, credit downgrades and political issues. And analysts believe that those have also cost South Africa. Some say the road to the country's economic recovery can be through investing in a green economy.
The president's leaning around the green revolution, focusing on renewables and the future, is a potential for revival of the economy of South Africa.
We need to also be thinking about how we are playing in the space and in the opportunities that exist from recycling and refabrication. I think we also have a big opportunity that comes from the potential for localization of certain components.
While the major rating agencies have all downgraded South Africa's economy to below investment status, economists have also encouraged the country to work on its fiscal position.
It is quite clear that there is no economic plan or strategy beyond the supplementary budget, which is an indication of where or the direction of the fiscal policy. The fiscal stimulus that has been mentioned is but a part of the greater economic cluster.
The African National Congress, as long as it continues using its own cadres, rather than South Africans who are capable, highly skilled and educated, this state is going to fail.
So all negative factors considered, is it worthy to invest in the South African economy?
South Africa boasts also of a renowned world-class economic infrastructure and a highly sophisticated financial system in terms of benefit the abundant resources, both in terms of human resources, but also in terms of natural resources that can definitely generate value for investors there.
President Cyril Ramaphosa says the country must work together to invest its resources in building a new economy in order to attract much-needed investment.
And that's our program today. Thank you for watching. I am Bisi Adebayo.